Alright, Chapter 9 demo. With the Chapter 9 demo, we're going to cover a couple things. We're first going to cover how to journalize transactions using credit cards, because you know that today businesses do allow their customers to purchase with debit or credit cards. And then we're also going to learn about something called an allowance for doubtful accounts when our accounts receivables may not end up paying their accounts receivable, and how we set money aside for that. And then we will learn our accounts receivable turnover ratio for this chapter as well. Now, with credit cards, all of you know that stores do offer a way for you to pay is with a credit card and or a debit card. Now, what the stores do is they negotiate with their credit card provider a fee, because that credit card provider is going to charge a fee for that service. And so you negotiate that, can be anywhere from 1% on up, and it's usually based off of the credit card transactions per week, per month, however the credit card provider charges for that. I'm sure that all of you know that today with credit cards and debit cards, that if you don't offer that to the customer, then you're doing yourself a very big disservice by not offering that. So not only do we take cash, most places do not take checks. Most businesses do not. They don't want the hassle of trying to collect if your check was bad, but they do offer credit cards. Now, our four credit cards that most places will accept is Visa, MasterCard, American Express, and Discover. Your book does talk about Visa and MasterCard. However, in our demo, we're going to use some fictitious companies. One called the Commerce Bank card, and then you'll see some different ones as you go through your homework as well. So for part one, what we're going to do is we are a company called Able, and they allow select customers to make purchases on credit, and that would be with the accounts receivable. Other customers can use either two cards, the Commerce Bank card or their own store card. And you know that a lot of stores offer a store card, like Home Depot, Lowe's, Kohl's. A lot of stores do offer their own credit card as well. Able uses the perpetual inventory system. Please keep that in mind, just like we learned in Chapter 6. And they charge a per month interest fee for any unpaid balance on its store credit card at the end of the month. So if you do not pay off your balance with the Able store credit card, then you will be paid interest on the unpaid balance. And I'm sure some of you know that can be anywhere from 9% up to 22, 25, 30%, depending on what you signed up for with that store card. So it's always a good idea, just on your personal financial side, to always pay off your balance on your credit cards monthly, so that the items that you purchase do not cost more than what you actually purchased them for. Now, the Commerce Bank deducts a 3% service charge for sales on its credit card and immediately credits the bank account of Able when the credit card receipts are deposited. So that could be that you batch out every day, and maybe only batch out once a week or whatever. Whenever you batch out, then that money is put into the checking account of the company. Able deposits the credit card bank, the Commerce Bank credit card receipts each business day. Then Able also completes transactions for the month, and the terms of the sale are 210 net 30. So we have that right up there. So that's kind of goes off of what we learned in Chapter 5. All right, so we do have a journal if you want to get that page ready here. And this is just going to be some partial transactions. It's not a full month of journal transactions, so we're not going to have a whole month's worth of activities here. Alright, so this is just pertaining, like I said, to accounts receivable and to credit cards. So let's go ahead and date August 4th. And our first transaction is that we sold $2,780 of merchandise that had a cost of $1,750 on credit to Stacy Dalton. So Stacy Dalton is one of our good customers, and we allow her to have an accounts receivable. So what we're going to do here is we will go ahead and put in for our first line, accounts receivable dash S Dalton. And then we have sales, sold merch on account. Now, because of the fact that all of the credit sales in terms of our accounts receivables are 210 net 30, we don't have to write that in our terms. And you will have a couple problems as you are going through your serial problems and your homework, that all the sales that we put on credit to our accounts receivable customers is all the same. So you'll have to kind of read your directions for that. But again, it's 210 net 30 for all of our credit sales. Alright, so this is a debit to accounts receivable, $2,780, and a credit to sales for the same amount, $2,780. And then we have to record the sale, so we'll put the fourth, cost of goods sold, and then our merch inventory, record sale for the explanation. And this is, again, the sale is at the retail price, the recording of the sale is at the wholesale price. So we'll debit our cost of goods sold, $1,750, and credit the inventory the same. Okay, so that is August 4th. Now, August 10th, we sold merchandise for $3,248 that had a cost of $2,456 to customers who use their Commerce Bank credit card. So they use the Commerce Bank credit card that Able Company accepts. So to record that, we're going to put the 10th. We start with cash, and then credit card expense, and then we're going to indent and put sales. Alright, our explanation, sold merch to customers using Commerce Card. And again, we want to go off the wholesale number, so that's going to be the $3,248, so that will be our sales, $3,248 credit to sales, and then the 3% fee. So I'll put the math here, $3,248 times 0.03, because that's the fee that Commerce charges Able to offer that credit card service, 3%. And that's going to be a new account called credit card expense, and that's going to be a debit just because it falls within all of our expenses, so we'll keep track of all of our credit card expenses in this new account. And that's going to be $97.44. Remember to use your rounding rules if that comes into play. And then the cash that gets deposited into the account of Able is going to be $3,150.56. So again, the total of the sales times 3% gives you $97.44, and then the difference between the sales and the expense, Able gets $3,150.56. Now, the other half of the transaction, we do need to record the sale, so we will put our cost of goods sold and our merch inventory. Alright, so again, cost of goods sold and merch inventory for the wholesale price. So that's going to be debit, $2,456 to cost of goods sold, and a credit to the inventory, $2,456. Explanation, record sale. So whether it's an on-account sale or if it is a credit card sale, we do need to record the sale. So we debit our cost of goods sold and credit our merchandise inventory for the wholesale price of the merchandise. Okay, then on the 11th, Able sold merchandise for $1,000. It has a cost of $600 and accepted the customer's Able store credit card. So this is their own store card, again, like Lowe's or Home Depot, Kohl's, stores like that. And we'll go ahead and record that as well. Now, we're not going to charge ourselves a fee, so we won't have that in the transaction. So we'll put the 11th for our date. Now, this is going to be accounts receivable. because these are customers that are going to use this credit card and they owe the company money. So it's not an individual person like Stacy Dalton. We're going to lump it all together into one. And then we'll have it separated out into their individual balances as we get the report of that. The credit will go to sales. So debit accounts receivable $1,000 and credit sales $1,000. And then explanation is to record, own, store, credit card sales. Own, store, credit card sales. Now as the customers pay, then we will take it out of the accounts receivable and then credit the accounts receivable and debit the cash as they pay on their credit cards. Okay, then on the 14th we received Dalton's check paying for the purchase of August 4th. And so August 4th again is the amount, and they get 10 days, so that falls right within the terms of the sale. So we'll go ahead and put the 14th. We're going to list our cash, sales discount, and accounts receivable. So again, Stacy owed us $2,780, so we'll go ahead and credit accounts receivable $2,780. And I'm going to put for my explanation here, receive payment on account. I'll put the math on here, 2780 times 0.02 for the 2% discount. So that's going to be a sales discount debit of $55.60. We're going to subtract those two, and the amount that Dalton will pay us is $2,724.40. $2,724.40. So again, just a review from chapter 5. Alright, now what I want to do is I'm going to come back to the 22nd, so let me come back to that one. And then we're going to do the 31st. Able recorded $75 of interest earned from its store credit card for August. So what again happened is that some of the customers did not pay off their entire balance that they owed, and so there was interest that they earned because of that, and it ended up being $75. So again, I'll come back to the 22nd. So here's the 31st. We're going to put accounts receivable and interest receivable. Explanation, record interest, earned on store card. Okay, so accounts receivable again, because the customers do owe us the $75 interest, we're just recording it at this time. So it's a $75 debit to accounts receivable, and then we'll credit the interest receivable. When we get the actual payment, then we'll reverse that entry and add that into our interest receivable and then put that to cash. Okay, so again, we did the 31st. I'll come back to the 22nd in just a minute here. So that's part one with credit cards. So again, we sold merchandise on account, just like we did in chapter 5. We sold merchandise using a outside credit card. Then we sold some merchandise using our store card. We received money from our accounts receivable, and then we recorded interest from our store card. Okay, so that's part one, and you'll have practice with that with the homework. Now, with part two, now this is where we're going to start talking about what happens when our accounts receivables don't pay. What happens when accounts receivables don't pay? Okay, so this is the Climate Company, and on December 31st of 2005, they had cash sales for the year of $1,015,000 and credit sales for the year of $1,241,000. In addition, they also had accounts receivables at the end of the year of $475,000, and Then they had this account that we're going to talk about called Allowance for Doubtful Accounts, has a $5,200 credit. Now, allowance for doubtful accounts. Let me draw you a T account. This is what we call a contra asset, and so it's going to subtract on debit and add on credit. And this account is going to set aside money in case our accounts receivables do not pay. So you'll see here that we have a $5,200 credit balance in that account at this point in time. And we only use this account with accounts receivable. So I'll put here, only used with accounts receivable. So we only use this allowance for doubtful accounts with our accounts receivable, the balance. And so that comes into play when we write up some journal entries that deals with accounts receivable. So companies are going to set aside money, and they're going to make an adjusting entry at the end of the year as to how much they think is going to become uncollectible. So in their budget for the year, which if you take Accounting 102, that's one of the big projects, is that you make a master budget for the whole year. But in that master budget, you're going to set money aside for your accounts receivables that don't pay. Now, we can base that off of past practices, or for a brand new company, we might check with our competitors and see how much they estimate that their customers will end up not paying. So we're going to estimate that 2.5% of the credit sales is going to become uncollectible. 1.5% of total sales will end up becoming uncollectible, and that 6% of our accounts receivables at the end of the year are going to become uncollectible. And these are normally the three different situations that we use to estimate bad debt. And again, we try really hard to collect, but sometimes it falls through the cracks. We can't get, what they used to call blood out of a turnip. We can't, use what they call dishonest practices. We do have an act out there called the Fair Debt Collection Practices Act, and there's rules. Even though people sign up to pay, they sometimes don't pay. And so, we can't call them at work, we can't harass them in the middle of the night, we can't knock on their door in the middle of the night, we can't threaten them, things like that. So as much as we try really hard to collect the money from them, sometimes we have to just, say it's a lost cause and we're not going to be able to get the money from them. So these are the three different situations we're going to talk about first, and we're going to write up some journal entries for that. So if you will go ahead, you have some more journal pages there. So if you flip to your next journal page. And the easy part of this is that there's only 2 accounts to remember, so that's the easy part of the journal entries for this. And so again, this is December 31st. And what we're going to do again is we're going to go ahead and we're going to figure out what we think is going to be our estimated bad debt using the 3 different situations. Okay, so first we'll go ahead and we're going to put bad debt expense. And then the second account here, put ALLOWFOR, DBTFUL, and then ACCTS, allowance for doubtful accounts. If you want to go ahead and write all that out, that's fine, but you can abbreviate it like that. So allowance for doubtful accounts. Explanation, record, estimated bad debt. Okay, so again, this first one was based off of our credit sales. So that was $1,241,000. So I'll show you the math here. 1, 2, 4, 1, and 3 zeros times 0.025, and that ends up being $31,025. So bad debts expense is an expense. They'll have a debit balance, and then this contra account, allowance for doubtful accounts, has a credit normal balance side. So we'll debit $31,025 for our bad debts expense. That sets that aside for 1 year. $31,025 goes to our allowance for doubtful accounts as a credit, and that will be a continuous account. It doesn't close out, and we will keep money in there, and hopefully we'll have too much in there or just the right amount that we won't have a lot of people that end up not paying more than what we thought. Okay, then the second way that we can estimate bad debt is off of our total sales. So we'll take our cash and credit sales, add those together. So put the 31st. Oh, and I can put letter A for the first one. This is B for the second situation here, so you can refer back. Bad debt expense and allowance for doubtful accounts. Explanation, same. Record estimated bad debt. Okay, so again, we're going to do this off of total sales. So we will take our cash sales of $1,015,000 and add with that our credit sales of $1,241,000. So let me add these together here real quick. 101. Helps if I push the right buttons here. 1015123 plus 1241123. So that gives us $2,256,000. And then we're going to multiply that by 0.015 in decimal form times 0.015. So that came out nice, neat, and even. And so again, we're going to debit our bad debts expense, $33,840, and credit the allowance, $33,840. So again, another way to do it. We're not going to do both. We choose one or the other. Now the third method that we could choose as well is to calculate our estimated bad debt off of our accounts receivable year-end balance. So I'm going to put the 31st bad debt expense and then allowance for doubtful accounts. Record estimated bad debt. Okay, so our accounts receivables were $475,000 for the year at year end, and we think that 6% is going to become uncollectible, which ends up being $28,500. Now, with that, we have a balance, like I mentioned, of $5,200 as a credit balance. So when you have a credit balance, this means that you overestimated. If you have a debit balance, that means you underestimated. So because this is a credit balance in our allowance for doubtful accounts, we overestimated and more people paid than what we thought. If it ends up being on the debit side, we underestimated and more people did not pay than what we thought. So that's something that we have to be careful with, and maybe we need to change that for the next year. So we're going to take our $28,500. We get to subtract the balance in there of $5,200 because we overestimated. So we really only have to write up our adjustment for $23,300. So that's good that we overestimated the year before, because then we don't have to put as much aside for this. Our bad debts expense debit, $23,300, and our allowance for doubtful accounts is the credit of $23,300. So again, you want to make sure that you keep this in mind, that if you have a credit balance, you overestimated, and if you have a debit balance, you underestimated. But we only use this balance with our accounts receivable estimation, not with credit sales or total sales. Okay, now that we know this part of it, we can also use another method. And so part 3 is going to be using the aging method. So Quisp Company has credit sales of $3.5 million for 2015. On December 31st of 2015, the company's allowance for doubtful accounts had an unadjusted debit balance of $4,100, so they underestimated the year before. Now, they do this by age. So what happens here is that they go through their accounts receivables and figure out of their accounts receivables the amounts that's not yet due, accounts receivable balances that are 1 to 30 days past due or 31 to 60 days past due, balances that are 61 to 90 days past due, and balances that are over 90 days past due. Based on past practices, they estimate what each of these different categories will end up becoming uncollectible. So what we're going to do is we're going to do a little bit of math here, and then we'll figure out what our adjusting entry should be for the bad debt. Okay, so of our not yet due balances of $296,400, we think that 2%, 0.02, will become uncollectible, or $5,928. For 1 to 30 days past due, there's $177,800 in balances. We think that 4%, or $7,112, will become uncollectible. Of our 31 to 60 days past due balances of $58,000, we think that 8.5 or 0.085, $4,930 will become uncollectible. 61 to 90 days past due, we have balances of $7,600. We think that 39%, 0.39, or $2,964 will become uncollectible. Usually the longer the debt is unpaid, the higher the percent. So of our 90 days past due, we have $3,700 in balances. We think that 82%, or $3,034, will become uncollectible. So you just multiply the amounts of the balances times the percent in decimal form, and you get the amount. Then we add all of these together. We get $23,968. So that's what we're expecting to become uncollectible, $23,968. Now, however, we underestimated the year before, so we have to add $4,100 in with that adjustment because we didn't have enough to cover it the year before, so we need to put more money with that for the adjustment. So, journal entry, flip over. You have another page here. This is December 31st. And we're going to write bad debt expense, allowance for doubtful accounts, record estimated bad debt, and again we calculated that $23,968 is going to become uncollectible, and we have to add in that $4,100 because we underestimated the year before, so we're going to end up with our adjusting entry of $28,068. So that's our debit, $28,068, and our credit to the allowance, $28,068. So when again you have underestimated, we add. When you overestimate, you subtract the balance that's in your allowance for doubtful accounts. Now we can go back and we can go back to our part that we skipped over, our 22nd transaction from the first page here. So when we have exhausted all of our options of trying to collect money the correct way, not the illegal way, the legal way, what we're going to end up doing is we will just write off the account. And so with that, it does ruin that company or individual person's credit, and hopefully they'll have a change of heart and repay. So we're going to write off the account of Ness City against the allowance for doubtful accounts. The $398 balance stems from a credit sale in November of the previous year. So it went from November of 2004, I believe that was what we were doing, was 20, I don't remember what year we used. Anyway, the previous year. So it went all of November, December, and then all the way through till August 22nd of the current year. So what we're going to do is we're going to go ahead and write them off. So the 22nd we have as our date, and to write off the account, what we're going to do here is we're going to put our allowance for doubtful accounts. We debit that, and we're going to close out the accounts receivable for Ness City. Now for our explanation, write off account past due. Alright, so with that, we're going to debit or take money out of the allowance for doubtful accounts. So we'll debit that $398, and then we will close out their accounts receivable with a credit of $398. Now, I want to go through a couple of transactions because sometimes the accounts receivables have a change of heart. Okay, sometimes they have a change of heart. So, what happens, I'll get another journal page here. So, well, I can just write it down here. Alright, so if accounts receivable that was written off decides to pay. So, if they have a change of heart and they decide they're going to pay, we have to reverse the accounts receivable for Ness City. So that will be our debit for $398, and then we put the money back in our allowance for doubtful accounts. So that will be our credit of $398. Okay, that's the first part. Now, what we're going to do is we're going to debit cash and then credit accounts receivable for Ness City. Now, we're not going to let them bring us in a company check. We'll ask for cash, money order, or certified bank check, and we will debit the $398 and then close out their accounts receivable with a credit of $398. So we reopen the accounts receivable and put the money back in the allowance for doubtful accounts. Then we record their cash and then close out accounts receivable. Now, will we let them have an accounts receivable with us? Probably not for a while, unless we can get some evidence or proof that they have gotten credit somewhere else and have gone ahead and done a better job. But again, it is going to affect their credit for some time. Just like in your personal life, if you have an account written off, it does take time to restore your credit rating as well. So that's something that you really need to think about with your business to make sure you pay your bills on time. Alright, and then the last part of our demo is our ratio. So I will go ahead and go to part 4 here of the demo. And so our accounts receivable turnover. And with the accounts receivable turnover, what we're going to do here is we're going to look and calculate that out for 2022. And the formula for this is net sales divided by your average accounts receivable. So it's net sales divided by your average accounts receivable. So we're going to go ahead and calculate this out for 2022. So we will take our net sales of $810,600. We're going to average together the 2 years of accounts receivable. So 152,900 plus 133,700. And we get with that 2,866,000 divided by 2, and that equals 143,300. Alright, so we're finding 2022, okay? And then we're going to take the 810,600, again we added together 21 and 22 and divided it by 2, and that's 143,300. Then we divide that out and we get 5.66 times. So they are able to, or our accounts receivables are turning over 5.66 times. So purchase, pay, purchase, pay, purchase, pay. So that's good. Again, you set yourself a goal or compare yourself to your competitors, or from year to year. If we knew 2020's numbers, then we could calculate this out again. But 5.66 times is pretty good. But again, you want to compare that to your previous year or your competitors to see how they're doing as well. Alright, so with the Chapter 9, you have your homework to go through and work on. There is not a serial problem for Chapter 9, so it's just working on the homework for Chapter 9.